Hello and welcome to an FXTimes daily market recap. I'm your CMS Forex fundamental market analyst, Nick Nassad. Today is Thursday, February 11th, 2010. Our main theme in today's session was the euro sliding against its rivals as EU leaders met regarding what to do about Greece's debt problems. The European Council President Herman Van Rompuy said that Eurozone countries have pledged to support Greece through its debt crisis, but that financial support was not necessary right now. Markets were looking for perhaps more specifics on aid than EU leaders were willing to provide, and the euro suffered as a result. What today's news means is that EU leaders are willing to give Greece a backstop as opposed to an outright bailout, and though that might stabilize the euro for a short period of time, the sovereign debt problems and prospects for weaker growth are likely to continue to pressure the euro in the coming weeks. In essence, the EU was saying to Greece that it will be ready with measures if Greece is unable to deliver on its promises to cut its budget, but that EU was not prepared to hand over a bunch of money to it right now to solve its problems. Now, despite the euro sliding, we did have risk appetite in the markets as the beginning of today's global session, which was the Asian session, we saw a very strong report from Australia in terms of their employment, and that helped the Aussie and some others like the New Zealand dollar and Canadian dollar to gain in overnight trading. The data helped to underpin confidence in the global recovery. We also, in the U.S. session, had a better than expected jobless claims report, so that could be a signal that the U.S. labor market is showing signs of improvement. Taking a look at the euro-dollar pair, we see that we had a sharp slide in today's trading, accelerating in the New York session, as the European Union officials failed to deliver details about their support for fiscally embattled Greece. The euro slide in North America trading took it back to levels we had seen on Monday and tested our low from Friday's session. And, that effectively wiped away the gains we had seen this week on optimism that a solution for Greece's budgetary problems was in the works. Our resistance now is pretty clearly established here at the 1.38 level, and we did have a bit of a bounce following our test of support at 1.36. U.S. equities were higher in late trading, and so that helped to boost overall risk appetite and help the euro to pair some of its initial losses. Here we're looking at the euro-pound pair, and in a similar fashion we wiped away all the gains that the euro had seen in the last three sessions. We tested support at about the 87 level, which was our level of support back here when we consolidated in this four-session sideways action. So again, we have to see whether this whether this support holds to end the week. Our second main theme was a strong employment rate from Australia, as the economy there added 53,000 jobs in January, figure that was better than expected, and also the fifth straight month of employment increases. That drove the unemployment rate to an 11-month low of 5.3%, when expectations had it rising slightly. As we can see from our chart to the right, that we seem to be, unemployment rate seems to have topped out at around 5.8 and is now decreasing. Australian employers have added 195,000 jobs since August, which is the biggest 5-month surge in 5 years. Such strong gains in the labor market can have an effect on the Reserve Bank of Australia, as this month the RBA Governor Stevens held rates steady at 3.75%, which surprised the market, and traders expected that perhaps the RBA would shift to a more gradual approach to raising rates. So while the bank may not feel the need to push too hard in response to this labor market report, if employment growth continues to sustain this pace, we'll obviously be perhaps seeing a shift of those expectations from traders that had expected perhaps a slower tightening campaign from the Reserve Bank of Australia. Taking a look at the Australian dollar US dollar pair, we see the sharp reaction to the better than expected employment report as we broke above an important level of resistance here at 0.88. That level had acted as support in last week's trading before we plunged below that level in Thursday's trading as we had a sell-off in equities. But today we moved back above that level. We tested the 0.89 level, which also coincided with a bit of a longer term downward sloping level of resistance, and after a bit of a pullback, we did now even break above that. So now we are testing this zone here between 89 and 89.50, which had previously acted as support and then as resistance. So we're facing a bit of a similar situation as we did here, as we're coming up against an important level, and we'll see whether the Australian dollar is able to push above that or not. In a look at the US dollar Canadian dollar, another currency that is sensitive to global growth concerns and overall risk appetite, we see that we fell in favor of the Canadian dollar, as I did mention stocks were higher in New York trading. We had plotted this support level in our video yesterday around 1.0550, and we smashed through that level in the New York session. That broke us out of this range we had been seeing the last several weeks. We can now plot Fibonacci levels to see that we have now retraced a little bit more than 50% of this upswing. In the U.S., meanwhile, we had a labor market report, weekly jobless claims, and for the week ending February 6th, claims fell by a very sharp 43,000 to 440,000. That result was better than expected and is a piece of evidence that the ailing labor market may have begun to heal. This comes at an opportune time, as claims had been rising the past several weeks and had begun to create some anxiety amongst economy watchers. We could see that increase here on our chart to the right, but we have now moved back downward in favor of this longer term trend, which is showing jobless claims continuing to fall. Also, for the week ending January 30th, continuing claims fell by 79,000 to 4.54 million. That was the lowest we had seen in about a year, though the lower level of continuing claims may not necessarily be a signal of improvement in the labor market, as it may just mean that some unemployed are exhausting their eligibility for regular benefits. In any case, the news did help U.S. equities to gain in today's session, which helped risk appetite. For instance, if we look at the pound-dollar pair, we see that in late New York trading, we saw a rise in favor of the pound after it tested its support near 1.5560. This pair, however, remains within a fairly well-established range now, with resistance here around the 1.5750 area. Now let's turn to the fundamental releases we can expect to end the week. Tonight at 4:45 p.m. Eastern, New Zealand posts its retail sales, an important indicator of consumer spending. Overnight, both Germany and the Eurozone will be releasing their preliminary versions of fourth quarter GDP growth, and also the Eurozone will post its industrial production figures. The UK, meanwhile, will release a measure of leading indicators. Tomorrow, the big release to watch for is going to be U.S. retail sales, which will come out at 8:30 a.m. That is followed around 10 a.m. by the UMich preliminary version of its February Consumer Confidence Index. At 10 a.m., we get figures on business inventories and a scheduled speech by Treasury Secretary Tim Geithner. However, that speech has been postponed, as it was supposed to be earlier in the week as a result of the snowstorms in Washington. The U.S. Treasury budget balance, which was scheduled for release on Wednesday, has also been pushed back, and we'll see if we get it in tomorrow's trading session. If not, those will be rescheduled for early on next week. And that will do it for today's fundamental recap. For more news, videos, and analysis, please visit our site FXTimes.com. I want to thank you for watching and wish you good trading.